Welcome to this video post from Fields Capital Strategies. We are a financial planning and consulting firm who base our strategies on two bedrock principles: guaranteed security and guaranteed growth for our clients and their money. In this presentation, we will look at mutual funds and how they represent their returns. In particular, we will talk about a fund's average return and that same fund's actual return. Let's begin by thinking about the following statement in regard to mutual fund investments. The average return is true, but it's not the truth. True or false? I contend that this statement is true, and the biggest misconception that mutual fund companies promote to their investors is the average return their funds make. You see, mutual fund companies never advertise the actual return earned on the funds they manage. They promote the average return earned. Why does this matter? Simply stated, the actual return is always less than the average return would imply. So, let's define average return and actual return. Average return. Mutual fund companies tell you how their funds have performed by showing you a 3-year, a 5-year, and 10-year average return for each fund they manage. How do they calculate this average return? It's simple. They total the annual return for each of the years and divide by the number of years in the average. But what does this average return imply? It implies that you can expect to earn the average each year you invest with them. But do you really? Actual return, on the other hand, or compound annual growth rate, referred to as the CAGR, is a formula which calculates the actual growth or true return of your investment over a selected period of time. You divide the ending value by the beginning value of your investment and factor in the number of years your money has been invested minus 1 to get your compound annual growth rate or true return on your investment. Now, that may be confusing, so let's look at an example to help us distinguish between average and actual return. Let's assume we have $100,000 to invest. So, we put this money into XYZ mutual fund. And in year 1, our return on the investment is 50%, or $50,000. And we end the year with $150,000 in our account. Year 2, we lose 50% of our investment balance, or $75,000. And we end year 2 with $75,000 in our account. When we average the return for 2 years, we have a 0% average return. That's plus 50% minus 50% equals 0%, divided by 2 equals 0% average for the 2-year period. So, what does that imply? If our average return is 0, shouldn't we still have our initial investment of $100,000 if we averaged 0 return each year? However, we have actually lost $25,000 in our total investment. Now that's quite a difference. Our actual return, or CAGR, is a negative 13.4% for the 2-year period. We lost 25% of our total initial investment, or 13.4% of our investment each year for the 2 years. Now, the easiest way to figure the true return on your investment is to use a calculator with the CAGR formula built in, which I use to find the 13.4%. But just to show you the calculator is correct, let's run the numbers. Subtracting 13.4% of $100,000 leaves us with a balance of $86,600 at the end of year 1. Then we subtract another 13.4% of the $86,600, and that leaves us with a balance of $75,000 at the end of the 2nd year. So, 13.4% is the true compound annual growth rate, or loss rate in this example. Now that is quite a difference between the 0% average annual return and the negative 13.4% return. Now, you may be saying that this example, it's not reality. So let's look at reality. Assume we invested the same $100,000 that we used in the previous example back in 2004 in the Dow Jones Industrial. These are the annual returns for the Dow for the last 10 years. In 2004, a little over 3%. In 2005, a little less than 1% loss in the Dow. In 2006, a little over 16%. In 2007, another 6%, and then in 2008 the Dow lost 33, almost 34% of its value, and so on down the list. When we add the positives, subtract the negative years, and divide by 10, we come up with an average return for the last 10 years in the Dow of 6.06%. with our investment growing to $158,566 in actual value. Now, let's apply this 6.06% average return for the 10-year period. The implied total return on our investment is $180,101. Quite different from the actual return of $158,566 our investment made. That's $21,535 less than the average return would imply. When we calculate the CAGR for the last 10 years in the Dow, we see that the true annual growth rate was only 4.72% each year. And when we put the average and the actual returns side by side, it should be easy to see the difference. So, why would mutual fund companies not disclose the actual return? Because average looks better than actual always. So, let's return to our premise statement. Average return is true, but it's not the truth. Would you agree or disagree? Don't get fooled by mutual fund companies and how good their returns look. Let's now look at a chart of the Dow Jones Industrials from 1999 to 2013. The Dow's performance, as this chart shows, has been up and down. But what happened in 2002 and especially in 2008. What would this chart indicate to you is due to happen with the stock market in the near future? If your retirement savings are invested in mutual funds, I ask you, are they safe? Let us at Fields Capital Strategies help you invest your qualified retirement money, your 401k, your IRA, in an asset which, number one, guarantees that your investment and returns will never decrease. Secondly, an asset that will allow you to profit when the market goes up, and you will not lose a dime when the market goes down. And thirdly, an asset which will increase your investment by 20% on day one. Yes, you heard that correctly. A 20% bonus credited to you on every dollar you invest. If this leaves you wanting to know more, contact us at Fields Capital Strategies. Thank you for watching this video post. Please subscribe to this YouTube channel, comment on the post, share this video on your channel or Facebook. Follow the link below to our Facebook. We hope to see you next time here on Fields Capital Strategies.